Welcome back to the deep dive. You know those aha moments? Like those flashes of insight that just hit you? Well, get ready, because today's deep dive is going to be packed with them as we explore the mind of Benjamin Graham.
Awesome.
Yeah. And we're tackling one of the most talked about chapters from The Intelligent Investor. That one all about how to handle those crazy market swings.
Oh, yeah, that's a classic.
So today, we're figuring out how to ride those market waves like pros without ending up, well, underwater.
Love it. This chapter is a must-read for any investor. It's amazing how relevant Graham's wisdom still is, even though he wrote this stuff ages ago.
Right. Like totally timeless.
Totally. Because whether it's the Roaring Twenties or today's tech craziness, human nature, especially when it comes to money and investing, it just doesn't change that much.
It's like those basic instincts, the fear and the greed. They always come out to play, don't they?
They sure do.
Okay, so let's get into it. Right off the bat, Graham makes this super clear distinction between timing the market and focusing on pricing. And he's pretty blunt about it, basically saying trying to predict where the market's going next is basically a fool's errand.
Straight up. He doesn't sugarcoat it at all. He calls that the speculator's game.
And not in a good way.
Definitely not. What Graham's all about is finding those investments that are priced way below what they're actually worth. That's what he calls intelligent investing.
So it's not about trying to catch those peaks and valleys. It's more about understanding the real value behind the stock.
Exactly. It's like you're not going to get it right every time trying to time the market. It's impossible. Graham actually gives this example about the Dow theory. Are you familiar with that one?
Yeah, I've heard of it. It uses those big swings in stock averages as signals to like buy or sell, right?
Right, like huge overall market trends.
But it seems a little, too good to be true, doesn't it? Like, if everyone knows the secret formula, does it still work?
That's a thing. And Graham actually points this out. He said the Dow theory's success rate totally tanked after it became really popular. It's like the more people jump on a trend, the less effective it actually becomes.
It's kind of like a paradox, isn't it?
Totally.
Makes you wonder about all those guaranteed trading systems you see advertised everywhere. Like, come on.
I know, right? They make it sound so easy.
But Graham, he doesn't stop there.
Yeah.
He also takes on the classic buy low, sell high strategy. That one everyone thinks is the key.
Oh, yeah. Buy low, sell high. Sounds so simple, right?
Right.
And what's interesting? It actually worked pretty well for a big chunk of the early 20th century. Back then, markets moved in these really predictable cycles.
So it was like clockwork.
Almost. But then something kind of crazy happened in the mid-1950s.
What happened? Did the clock break?
Kind of, yeah. Those nice, neat, predictable cycles started to disappear. They got all messed up.
Interesting.
And all those fancy formulas everyone was using, they just stopped working. Investors were like, what just happened?
I bet. So blindly following a formula, no matter how popular it is probably not a good idea.
Yeah, sticking to a formula, especially when it's become the hot new thing, it can totally backfire.
So what's the alternative? If we can't rely on timing or these formulas, how were we supposed to navigate this crazy market?
Well, that's where Graham introduces one of his most famous ideas, the idea of Mr. Market.
Okay, Mr. Market. I'm intrigued.
So imagine Mr. Market as this, I don't know, kind of eccentric guy who shows up at your door every single day. And he's got an offer for you, either wants to buy your stocks or sell you some of his.
Okay, sounds friendly enough. So what's the catch?
The catch is Mr. Market, he's a total emotional roller coaster. His offers are all over the place, driven by fear one day, greed the next, almost never by logic. Some days his prices might seem reasonable, but most of the time they're just way off.
Ah, I see where this is going. So Mr. Market's that guy at the party you try to avoid.
Exactly. But here's the key. You don't have to take any of Mr. Market's offers. He can shout prices at you all day long, but you have the power to choose.
So it's all about recognizing when he's being emotional, when he's letting those feelings get the best of him and not getting swept up in it.
Yeah, you don't let Mr. Market's drama dictate your investment decisions. You got to stay calm, assess the situation, and make your own informed choices. You're the one in control, not Mr. Market.
I love that. It's like taking back the power.
Toy.
Okay, so we've met Mr. Market, and I think we can agree he's not exactly the most reliable guy.
Yeah.
But to really drive this point home, Graham brings in this fascinating case study. The wild ride of A&P stock.
Oh, yeah. The A&P, the grocery chain, right. Their stock went through some crazy ups and downs between 1929 and 1972.
Like a real roller
A
coaster.
real. At one point, get this, their stock was selling for less than the company's net current asset.
Wait, so the entire business was valued at less than the cash they had on hand. How's that even possible?
It's a perfect example of Mr. Market at his worst. Investors were so panicked that they totally ignored the actual value of the company.
Wow.
But then, fast forward to 1961, the stock was trading at a crazy high price, like 30 times its earnings. It's like people forgot that the grocery business is actually pretty stable.
It's like they were betting on A&P suddenly becoming the next, I don't know, the next big tech company or something.
Right, and that's exactly what Graham's warning us about. He saw parallels between A&P's story and all the crazy valuations of those, like, super hyped growth stocks in his time.
So even the most successful companies, they could be affected by these wild price swings driven by, well, basically speculation,
Hmm.
emotion.
Absolutely. And that's why Graham emphasizes this point. Focus on how the business is actually performing, not the hype surrounding it. He believed that over time, good management will lead to good average market prices for a stock.
So it's like tuning out all the noise and focusing on the real signal.
Exactly. Don't get caught up in Mr. Market's drama. Just focus on the basics. Is the company well managed? Are their earnings growing? Do they have a good future?
Okay, so we're learning to ignore Mr. Market and focus on the business itself. Got it.
Yeah. But what about bonds? Aren't those supposed to be, the safe haven when things get rough?
You'd think so, right? But even those super safe, high-grade bonds, they can see some pretty big price swings too.
Wait, really? Why is that? I thought bonds were all about stability.
It all comes down to interest rates. See, when interest rates go up, bond prices usually go down. Graham uses this example of a Northern Pacific Railway bond, a 3% bond. This bond lost 2/3 of its value just because interest rates went up. And it wasn't because the company was doing poorly or anything.
Wow, that's kind of scary. So even when you think you're playing it safe with bonds, you're still exposed to those market forces.
You are. And that leads us to another interesting idea from Graham. He actually proposed creating a new type of bond, one where the interest payments would change along with the current interest rates. Interesting. So like a built-in adjustment.
Exactly. So the bond's value would stay pretty stable, but the income you get from it would adjust to whatever's happening in the market.
That's smart. It's kind of like he predicted those inflation-protected bonds, those TIPS that we have today.
It really is. It shows how ahead of his time Graham was. He saw the problems with traditional bonds and was already coming up with new solutions.
It's a good reminder that there are always new ways to approach investing, new ways to manage risk.
Absolutely. Now, let's shift gears a bit and talk about one of Graham's core concepts, the difference between a true investor and a speculator.
Okay, I've heard those terms thrown around a lot. What's the real difference?
Well, for a speculator, it's all about those short-term gains. They're obsessed with trying to time the market, catch those waves and make a quick buck, like those people who piled into GameStop or AMC a few years back, hoping to get rich overnight.
Ah, the get-rich-quick crowd.
Exactly. But Graham, he's not a fan of that approach at all. He says the true investor takes a totally different route. Their goal is to build wealth steadily over the long term. They choose valuable assets and hold on to them, patiently letting them grow.
So they're not stressing about every little dip in the market. They're playing the long game.
They are, and that's where the real power of being a true investor lies. You're not constantly doubting yourself, letting fear and greed make your decisions. You're making calm, rational choices based on the long-term potential of those businesses you own.
It sounds almost too simple, but in today's world where everything is so fast-paced, we forget about the power of patience.
It's true. There's so much information, so many opportunities coming at us all the time. It's easy to get caught up in the frenzy. But Graham reminds us that investing isn't about getting rich quickly. It's about building sustainable wealth brick by brick over time.
So slow and steady wins the race.
Exactly. And here's another key point. Graham says the existence of a stock market doesn't actually change the true value of a business. He uses this example of someone owning a share in a private company.
Okay, I'm listening.
So let's say you own a piece of a private company. If that business is doing well, making money and growing, it's going to be worth more over time, right? Whether or not there's a public market for its shares is almost beside the point.
So the stock market is just a platform, a place to trade those shares, but the business itself is what really matters.
Exactly. And that's why Graham wants us to think like owners, not just traders. Focus on the fundamentals. How's the company doing? Are they growing? Are they making money?
Makes total sense. It goes back to what we were saying earlier about ignoring Mr. Market's crazy moves
Mhm.
and focusing on the real deal.
You got it.
This is good stuff.
Right. And it actually leads to one of Graham's most powerful statements. He says, and I'm going to quote him here, "The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage."
Oh,
Yeah, he keeps going. He says, "That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment."
wow. Deep thoughts from Benjamin Graham.
Yeah, deep stuff. But what he's basically saying is if we let those market ups and downs get to us, we're letting other people's emotions control our financial well-being.
That's a good point.
It's about taking control of your own investment decisions, not letting the crowd's fear or greed dictate your moves.
So how do we actually do that? Does Graham have any practical advice on how to handle those inevitable market swings?
He does. He recommends using what he calls a mechanical method for adjusting how much you have in stocks versus bonds.
Okay, break that down for me. What does that mean?
It's pretty simple. As the market goes up, you gradually shift more of your money into bonds. And when the market goes down, you shift more into stocks.
So it's kind of like a built-in rebalancing system.
Exactly. It helps you take advantage of those market swings without getting caught up in all the emotional drama.
That makes sense.
But here's the thing. Even when we think we've cracked the code, found the perfect formula for buying low and selling high, Graham would probably tell us to think again.
Really?
He really believed that any approach that's too simple, too popular, or relies on predicting the future is bound to fail at some point.
So no matching formulas, no crystal balls.
Nope. But I bet he had his own series, right?
I bet he did.
He did. He even experimented with his own method for timing the market, what he called the central value method.
How did that go?
Well, true to form, he admitted it worked great until it became too popular.
Huh. It's like the market has a sense of humor. As soon as you think you figured it out, it changes the rules.
Exactly. It's a good reminder that none of us can predict the market perfectly. There are always going to be surprises.
So instead of trying to be smarter than the market, we should focus on what we can control, our own behavior, our research, and our long-term strategy.
That's the Graham way. Be patient, be disciplined, and always, always focus on value. Remember, the market is there to serve you, not to rule you.
Now that is a powerful thought.
It is. And it's a good place to wrap up this part of our deep dive into Benjamin Graham's wisdom.
Okay, so we've covered a ton of ground already, from market timing and pricing to the psychology of investing, bond fluctuations, the importance of business performance, and even a little bit about the role of management.
We've even touched on the relationship between how businesses are valued and how the stock market values them, which can be a bit of a head-scratcher sometimes.
It is. But I feel like I'm starting to understand Graham's approach, like getting a handle on his whole philosophy.
That's great. And there's still more to uncover. We've got one more crucial piece of Graham's wisdom to explore before we wrap up this entire deep dive.
Okay, I'm all ears. What's the final piece?
It's all about management. Graham was convinced that a company's stock price, in the long run, should reflect the quality of its leadership.
So good management equals a good stock price. Sounds pretty logical, but how does that actually work in the real world?
Well, what Graham is saying is that shareholders need to hold management accountable for how the stock performs. He knows that those short-term ups and downs, those aren't always the fault of management.
Right. Mr. Market can throw a wrench in things, no matter how good the leadership is.
Exactly. But Graham says management is definitely responsible for the long-term direction of the stock.
So if a company's stock keeps doing poorly for years and years, it could be a sign that management isn't doing their job, not creating value for the shareholders.
That's right. And Graham was a big advocate for shareholders being more active, speaking up, and holding management accountable. It's an idea that's even more important today with so much focus on how companies are governed.
It makes sense. It is our money after all. Okay, so let's try to sum this all up. We've talked about market timing, pricing, the psychology of investing, bond fluctuations, the importance of business performance, even the role of management. Wow, that's a lot.
It is. But I think the key takeaway is that Graham gives us a framework for thinking about investing that really stands the test of time. It's not about blindly following a set of rules. It's about learning to think for yourself, making smart choices based on your own goals and how much risk you're willing to take.
He's giving us the tools to become those intelligent investors he always talks about. I like that.
Right. Knowledge is power.
Before we wrap this up completely, there's one more quote from Graham that I think perfectly sums up everything we've been discussing. He says that market fluctuations, those ups and downs, they're just part of the game. They're going to happen. They're unavoidable.
Yeah, he actually compares it to a ship sailing on the ocean. There are always going to be waves, that's just part of it. But a good captain doesn't change course every time the ship hits a little rough water.
They stay focused on the destination, the long-term goal.
Exactly. And that's what we need to do as investors, too. Keep our eyes on the prize, that long-term value, and try not to get distracted by all the noise happening in the market every day.
You know, it might sound a little crazy, but Graham even suggests we should be happy when the market goes down.
Haha, I know, it seems counterintuitive, right? Yeah. But his reasoning makes a lot of sense.
Okay, I'm curious. Tell me more.
So those market drops, those are the times when the real bargains start to appear. It's like a giant sale at your favorite store. All those great companies you've been watching, suddenly they become a lot more affordable.
So instead of panicking and selling everything when everyone else is freaking out, the intelligent investor sees it as an opportunity.
Exactly. It's that contrarian mindset. But it takes a lot of discipline and a real understanding of value to pull that off.
So what's the takeaway message for everyday investors like us who are just trying to make sense of this whole investing world?
I think the most important thing is to shift our perspective. We need to stop thinking like those speculators, chasing the latest hot stock or trying to time the market perfectly.
Yeah.
We need to start thinking like owners, focusing on the long-term value of the companies we're putting our money into.
And remember that those market swings, they're totally normal, not something to be scared of. They're just chances to buy low, sell high, adjust our portfolios, and stay on track toward, well, toward financial freedom.
And as Graham always said, the more it changes, the more it's the same thing. You know, human psychology is what drives markets. That hasn't changed. Staying disciplined and focused on value, that's the key for any intelligent investor.
So there you have it, a deep dive into Benjamin Graham's wisdom on handling those market ups and downs. I don't know about you, but I learned a lot.
Me too. And remember, like any great investor, Graham would tell us to keep learning, keep asking questions, and keep trying to become even better investors.
Awesome. That's it for this deep dive. Until next time, happy investing. Okay, so we're learning to ignore Mr. Market, not let him get in our heads, and focus on the actual business. Got it. But what about bonds? Aren't those supposed to be like the safe bet, the thing you turn to when the market gets all stormy?
Yeah, you'd think so, right? Safe and steady. But even those super safe bonds, the high-grade ones, even those can get hit with some pretty wild price swings.
Seriously? Why? I always thought bonds were all about stability.
Well, the thing is, it all comes down to interest rates. When those rates go up, bond prices, they tend to fall.
Huh.
Graham actually uses this really striking example, the Northern Pacific Railway's 3% bond. And get this, that bond lost, like, a whopping 2/3 of its value.
Whoa, 2/3? That's a huge drop.
It is, and it was all because interest rates went up. It wasn't even that the company was doing badly or anything.
That's a little unsettling. So even if you're being super cautious and going with bonds, you're still not totally immune to what's happening in the market.
That's right. And this brings us to another one of Graham's brilliant ideas. He actually suggested this whole new kind of bond, one where those interest payments, they would actually fluctuate, go up and down, along with the current interest rates.
So kind of like a built-in adjustment mechanism.
Exactly. That way, the bond's principal, the main amount, that would stay pretty stable. But the income, the interest payments, they would change, adjust to the market.
That's actually pretty genius. It's almost like he kind of foresaw things like TPS, those Treasury inflation-protected securities that we have nowadays.
It really is. Shows how forward-thinking he was. He totally understood the limitations of those traditional bonds and was already thinking about new, creative solutions.
It's a good reminder that there are always, new approaches to investing, new ways to manage that risk.
Absolutely. Now let's switch gears a bit. Let's talk about one of Graham's really core concepts, the difference between a tree investor and a speculator. Those two words get thrown around a lot, but what do they really mean?
Yeah, I've heard those terms, but I'm not always sure what the real distinction is.
Well, for the speculator, it's all about the short term, those quick wins. They're obsessed with timing the market, catching those waves, and making a quick buck, like those people who piled into GameStop or AMC a few years back, hoping to strike it rich overnight.
Oh, yeah. The get-rich-quick crowd. I remember that.
Exactly. But Graham, he wasn't a fan of that approach at all. He said the true investor, they take a completely different path. Their goal is to build wealth slowly and steadily over the long haul.
They're not stressing about every little dip in the market. They're in it for the long game.
They are. They carefully pick those valuable assets and then hold on to them. They let them grow patiently. And here's the really cool part. True investors, they rarely need to sell their shares. They just sit back and let that compounding work its magic.
It's like they're planting a seed and watching it grow into a tree.
Right. And that's where the true power of being a true investor lies. You're not constantly doubting yourself, letting fear and greed rule your choices. You're calm, rational, making decisions based on the long-term potential of those businesses you own.
It sounds so simple, but in today's world where everything is like instant gratification, it's tough to remember the power of just being patient.
It's true. There's just so much information, so many opportunities bombarding us from all sides. It's easy to get swept up in the chaos. But Graham reminds us, investing, it's not about getting rich quickly. It's about building that sustainable wealth brick by brick over time.
So slow and steady wins the race. I get it.
You got it. And here's another key insight from Graham. He actually says that the existence of a stock market, it doesn't actually change the inherent value of a business. He uses this example of someone who owns a share in a private company.
Okay, I'm listening.
So imagine you own a piece of a private company, right? If that business is doing well, making money, growing, its value is naturally going to increase over time.
Right.
Whether or not there's a public market for its shares, well, that's almost irrelevant.
So the stock market is just a platform, a way to trade those shares, but the real value comes from the business itself.
Exactly. And that's why Graham really encourages us to think like business owners,
Yeah.
not just stock traders.
Okay, I like that.
Focus on the fundamentals. How's the company performing? Are they growing? Are they making money?
It totally makes sense. And it goes back to that idea of like ignoring Mr. Market's mood swings and focusing on the real underlying business.
Exactly. And this leads to one of Graham's most powerful statements. He says, and I'm going to quote this directly, "The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage."
Wow, that's a mouthful.
I know. But he's basically saying, if we let those market ups and downs get to us, we're letting other people's emotions control our financial well-being.
It's like we're giving away our power.
Exactly. It's about taking charge of your own investment decisions, not letting the crowd's fear or greed dictate what you do.
I like that. Taking control.
Yeah.
So how do we actually do that? Does Graham give us any advice on like practical steps to handle those inevitable market swings? Because let's be real, they're going to happen.
He does. He recommends using what he calls a mechanical method for adjusting, how much you have in stocks versus bonds in your portfolio.
A mechanical method.
Yeah.
What's that all about?
It's pretty simple, actually. As the market goes up, you gradually shift more of your assets into bonds, and when the market goes down, you shift more into stocks.
So it's like a rebalancing system kind of built in.
Exactly. It helps you take advantage of those market swings without getting too caught up in all the emotional ups and downs.
So even when we think we've like cracked the code, found the perfect formula for when to buy and sell, Graham would probably tell us to take a step back, to rethink things.
He probably would. He really believed that any approach that's too simple, too popular, or, relies on predicting the future, well, it's bound to fail at some point.
So no magic formulas, no crystal balls.
No.
But I bet he had his own theories, right?
Yeah.
I mean, he was a brilliant guy.
He did. He actually experimented with his own method for trying to time the market. He called it the central value method.
Ooh, interesting. How'd it go?
Well, like a true gentleman, he admitted it worked great until it became too popular.
Ha! I think the market's got this like mischievous sense of humor.
Yeah.
Just when you think you've figured it out, it throws a curveball.
It's true. And it's a good reminder, none of us can predict the market perfectly. There will always be surprises.
So instead of trying to, I don't know, outsmart the market, we should really just focus on what we can actually control, right? Our own behavior, our research, our long-term strategy.
That's the Graham way. Be patient, be disciplined, and always focus on value. Remember, the market is there to serve you, not the other way around. You're in charge.
That's a really powerful thought.
It is. And it's a perfect spot to pause for now. We've done a deep dive into a lot of Graham's wisdom so far.
We have market timing, pricing, the psychology of investing, all those bond fluctuations, the importance of the business itself, not just the stock price.
And we've even touched on how businesses are valued, how the stock market values them, which, I'll be honest, can get a little confusing.
It can. But I feel like it's all starting to click for me now. I'm getting a handle on Graham's philosophy.
That's fantastic. And you know what? There's one more really crucial piece of his philosophy that we need to talk about before we wrap up this whole deep dive.
Okay, I'm ready. Lay it on me. What's this final piece all about?
Well, it all comes down to management. You see, Graham, he was really convinced that a company's stock price over the long term, it should actually reflect the quality of its leadership.
So good management, good stock price. Makes sense, but how does that work in reality?
It's all about accountability. Shareholders, we should be holding those managers accountable for how the stock is doing. Now, Graham he knew those short-term swings, they're not always the fault of management.
Right. Like we said, Mr. Market, he can really stir things up no matter how skilled the people running the company are.
Exactly. But Graham's point is, management, they are absolutely responsible for the long-term trajectory of the stock. They set the course.
So if a company's stock has been lagging for years, underperforming, it could be a sign that management isn't creating value for the shareholders, right?
That's what Graham thought, and he was a big advocate for shareholders being more active, more vocal, speak up, hold those managers accountable. It's an idea that's, well, it's even more important today with all the focus on corporate governance.
Right. Because it's our money. Okay, let's try to bring this all together. We've gone deep on Graham's ideas about market timing, pricing, the whole psychology of investing, the ups and downs of bonds, how important the business's performance is. Wow, it's a lot to take in.
It is quite a journey. But the big takeaway, I think, is that Graham, he offers this timeless framework for thinking about investing. It's not a set of rules, it's more like a way of thinking. Learning to think critically, making smart choices that match your goals, your own risk tolerance.
He's giving us the tools to become those intelligent investors he talks about.
He is.
Love it. Okay, but before we say goodbye, there's this one quote from Graham. It's like he sums up everything we've been discussing. He said those market fluctuations, all those ups and downs, they're just part of the game. Inevitable.
He actually compares it to a ship sailing on the ocean. There are always going to be waves, it's just part of the experience, but a good captain, they don't change course every time the ship hits a bit of rough water.
They stay focused on the destination, that long-term goal.
Exactly. And that's what we got to do as investors. Keep our eyes on the prize, that long-term value. Try not to get sidetracked by all the daily ups and downs in the market.
This might sound a little crazy, but Graham actually says we should be happy when the market goes down.
Haha. I know, it's kind of counterintuitive, right? Like, wait, what? But his reasoning is actually pretty brilliant.
Okay, I'm all ears. Explain this one to me.
Well, he says those market drops, those are the times when the real bargains pop up. Like a giant sale. Everything's marked down. All those fantastic companies you've been watching, suddenly they're more affordable.
So the intelligent investor, instead of panicking when everyone else is selling, they see those drops as an opportunity, a chance to buy.
Exactly. It's all about being a contrarian, going against the crowd. But to pull that off, you need a lot of discipline and a deep understanding of what true value is.
So last question, what's the message for all of us everyday investors trying to navigate this crazy world of investing?
I think the most important thing is we need to shift our perspective. We got to stop thinking like speculators, chasing those hot stocks, trying to time the market perfectly.
Okay.
We need to start thinking more like business owners. Focus on the long-term value of those companies we're investing in.
We're not just buying a ticker symbol. We're buying a piece of a business.
Right. And we need to remember those market fluctuations, they're totally normal. It's not something to be afraid of. They're actually opportunities. Opportunities to buy low, sell high, adjust our portfolios, and stay focused on our path to, well, to financial freedom.
And that's what it's all about. So that wraps up our deep dive into Benjamin Graham's wisdom on navigating those inevitable market ups and downs.
Yeah.
I feel like I've learned a ton.
Me too. It's been a great discussion. And like any great investor, Graham would encourage us all to never stop learning, keep asking those questions, and keep striving to become even more intelligent investors.
Absolutely. And on that note, that's it for this deep dive. Until next time, happy investing, everyone.